Did you know that retail bankruptcy have shot up by a whopping 61% in the past year? And there's been a 77% surge in store closures across the United States. Recent report from Retail Dive and Credit Risk Monitor has shed light on which retailers might be in danger of going bankrupt by late 2023 or are already filing for Chapter 11. We should expect more empty stores and product shortages this season as more brands abandon physical shops, causing significant disruption in the retail industry in the coming months. So let's check out which retail stores will be one of the casualties in 2023. Number 10, 99-cent store. Now over to 99 cents only, the discount retailer which is feeling the pinch with wider losses in its latest quarter as sales and margins continue to slide. They reported about $480 million in sales for the quarter, a 3.8% drop year over year. To make matters worse, they posted a $27 million loss. Their gross margins took a 5% hit. Moody's even took the liberty of downgrading their corporate credit rating, signaling a higher risk of default and bankruptcy. According to Moody's Vice President Mickey Chadha, this downgrade comes from the company's weaker-than-expected performance and tight liquidity. On top of all this, the discount chain is losing ground to competitors like Dollar General and Dollar Tree. Plus, discount grocers like Aldi are gobbling up market share, making 99-cent only stores less appealing to both investors and consumers. Number 9, Soft Surroundings. Soft Surroundings, the women's apparel and home decor store, is calling it quits for good. They've been struggling for a while now, especially since mid-2022, when folks started losing interest in their products. A few months back, they tried laying off some employees to save money and pay off their debts, but honestly, it wasn't looking too hopeful, given how much they owed. According to their bankruptcy filing, they've got assets valued at up to $50,000, but liabilities between a whopping $50 million and $100 million. Right now, they're on the hunt for someone to buy their physical stores and a lender to help fix their online operations. But with their serious financial issues, it's kind of surprising they didn't hit rock bottom sooner. Number 8, Big Lots. Big Lots, the discount retailer, is going through some tough times financially. They've had several quarters in a row with sales dropping by double digits, and in August, it was a 15% drop. Big Lots CEO Bruce Thorne points to inflation hurting their low-income customer base, which is making their money troubles even worse. This isn't a new problem. Their revenue, profit, retained profit, total assets, and net worth have all been shrinking while their debts are going up. It's a dangerous mix that's getting them closer to going bankrupt. Credit Risk Monitor experts say they've lost 71% of their market value since October 2023, which is a big red flag that they might close down by the end of the year. Number 7, Petco. Petco had a fantastic run during the pandemic. With the surge in consumer demand, their pet supply chain saw a massive increase in annual sales, and their stock price doubled. But as the economy reopened, people shifted their spending towards other products and services, and this hit Petco hard. Financial experts started to view the company as a risky investment due to their high debt levels and slowing sales. In August, their shares took a nosedive, dropping by 24% in just a week, and their market capitalization fell even by 20% in September this year. With a whopping $3.03 billion in debt, Petco is in a precarious financial situation and could be looking at bankruptcy. They're currently on a bankruptcy watch list and have a looming $800 million loan payment due this quarter, which, if not met, might force shareholders to push for a debt reconstructuring plan or even Chapter 11 bankruptcy. Number 6, Farfetch. The luxury retailer Farfetch had a rough 2023 with a whopping 40% drop in market capitalization. The main culprits? Decreased demand in their key markets, the US and China, thanks to inflation and recession concerns. Their recent earnings report didn't bring any good news either, as it fell short of revenue expectations. To add to their woes, Farfetch is dealing with a surplus of spring and summer inventories, which led to reduced fall and winter wholesale orders. We have seen a less buoyant luxury customer in the United States and in mainland China. The reality is that the recovery has not been as robust as we'd expected when we reported our Q1 results, CEO Jose Nieves said during a recent earnings call. Their stock hit a low of $1.86 and got downgraded by JP Morgan and KeyBank, with several brokerages lowering their price targets. It's a tough situation, and Farfetch is teetering on the edge of bankruptcy. Number 5, Kohls. Kohls, the iconic department store, is pointing fingers at the middle-class squeeze for its retail business decline. But experts are quick to argue that the chain's problems are mostly self-inflicted. After a 6.6% sales dip and $32 million in losses, global data analyst Neil Saunders points the finger at Kohls' lack of standards and operational control. They've been leaning heavily on partnerships with other retailers like Amazon and Sephora for traffic and sales, which many see as an unsustainable strategy. Insider intelligence analyst Zach Stambor notes that Kohls has been grappling with sluggish sales and investor criticisms. With a new top executive, a challenging economic outlook, and a daunting 71% risk of bankruptcy, Stambor underscores just how tough it'll be to turn the company around. Kohls has got to tackle these issues head-on if it wants to survive and thrive. Number 4, Kirkland. Kirkland's, the home decor and furniture retailer, faces dire prospects amid the economic downturn. Retail experts caution of impending trouble. Durable goods, including furniture, struggle in a weak economy, putting Kirkland's in a precarious position. Across its 360 U.S. stores, sales disappoint with a loss of nearly $100 million in revenue since 2022. Profit margins plummeted from 32.81% to a mere 2.31%. Cash reserves have dwindled from $8.16 million to $25 million in H1 2023. Despite banking on a robust holiday season, it failed to salvage their situation, leaving them burdened with a $33 million debt. Securing loans becomes a formidable challenge with tightening lending standards and rising risks. Kirkland's teeters on the brink of bankruptcy, with the fourth quarter appearing as a critical turning point. Number 3, Rent the Runway. Rent the Runway, the popular fashion rental retailer, used to be a hit with budget-conscious women. They had tons of brand partnerships, a range of sizes from 0 to 22, and 3 different subscription plans, bringing in 11 million subscribers. But things have taken a sharp turn for the worse. In 2020, they lost 60% of their active subscribers and reported a $171 million loss. The downward spiral continued as they had to restructure their business, which included laying off 24% of their corporate staff. Subscribers kept dropping. Their stock price fell by a massive 90%. Because of all these problems, credit risk monitor experts are saying that the Rent the Runway probably won't make it past 2023. Number 2, The Container Store. The Container Store's financial journey has been quite a roller coaster in recent years. After the initial hit from the pandemic with the injection of stimulus funds in December 2020, they saw a 20.5% surge in sales, which peaked at 38.4% in early 2021. But then, unfortunately, consumer spending on home goods took a dive, and U.S. sales slumped by 24%, leading to a 21% drop in net sales in the first quarter of 2023. The CEO, Satish Malhotra, attributed this to a tough overall economic environment, and he responded by laying off a large number of employees and taking a 10% pay cut to provide raises and severance packages for the remaining staff. On top of all this, the company's stock price plummeted by a staggering 59% in the past year, raising concerns about the possibility of bankruptcy in 2023, as noted by Credit Risk Monitor. Number 1, Mitchell Gold. Now, Mitchell Gold, the furniture maker known for the Mitchell Gold and Bob Williams brand, has gone bankrupt, causing their operations to come to a sudden stop. This means a bunch of products, including ones that people have already paid for, are stuck in their warehouses and at third-party distribution centers. That's causing some pretty major delivery delays. Their money problems are what triggered this crisis. They revealed that Ryer Last Mile is holding over 2,000 Mitchell Gold products for about 600 customers, while Furniture USA Distribution has more than 1,300 of their items. Altogether, they estimate there's about $6.5 million worth of products stranded at these third-party spots and an extra $17 million worth in their own facilities. It's a big setback for stores depending on holiday sales, and it might lead to a temporary shortage of winter furniture. Tough times in the retail world, isn't it? The retail apocalypse persists, jeopardizing established brands and foretelling more store closures by 2024. Are these trends indicative of a changing retail landscape? Do you think these companies can turn things around? Share your thoughts in the comments below. Don't forget to like, subscribe, and hit that notification bell for more insightful content. Thanks for watching.